In this video, I am going to cover a concept and phenomenon of more and more importance to the analysis and valuation of a public company, especially a high-growing one. That is stock-based compensation, or SBC for short. Topics will be talked about: what is it, some examples and why is it important in analysis, and how to incorporate it into my valuation model. Some may be wondering why this topic was brought up and probably do not have adequate understanding of the importance. Let's start with two case studies to have a peek. According to the latest earnings report of Zoom Video, whose stock price soared during the COVID-19 pandemic, but has since come back down to earth, its stock-based compensation was $1.2 billion, which is 27% of its revenue of $4.44 billion. This is a significant increase from previous year, when stock-based compensation was only 14% of revenue. Zoom Video's annual operating results were disappointing, as the company reported a 3.9% decline in earnings per share and a mere 1.2% growth in revenue. These numbers suggest that Zoom Video is losing its competitive edge in the video conferencing market and is overpaying its employees with stock options that dilute shareholder value. Another example is Palantir, a star company that provides data analytics software to help organizations make better decisions with their data and AI models. By the end of 2022, the company's revenue growth slowed down significantly, while its net income remained negative due to high stock-based compensation expenses. Palantir paid $0.565 billion in stock-based compensation in 2022, which was 27.42% lower than 2021, but still represented 29.6% of its total revenue. This is an unsustainable practice that dilutes shareholder value and undermines the company's long-term prospects. Palantir has been criticized by its shareholders and demanded to reduce its reliance on stock-based compensation and focus on improving its profitability and cash flow generation. As a more macroscopic illustration, the chart shows the median stock-based compensation as the percentage of revenue for the SaaS companies since 2015. SaaS stands for Software as a Service. It is a cloud-based software delivery model in which applications are hosted by a vendor and accessed by users over the internet, and has been a popular flavor of entrepreneurial high-tech companies. As you can see, the average stock-based compensation for high-growing tech companies has been increasing steadily since 2015. This is likely due to a number of factors, including the increasing cost of living, the increasing competition for top talent, and the increasing use of stock-based compensation as a way to attract and retain employees. Given the data shown previously, stock-based compensation, SBC, has become an important factor to consider when valuing a stock. SBC is a form of compensation that is given to employees in the form of shares or options to purchase shares in the company. SBC can have a significant impact on a company's financial statements, and it can also affect the company's valuation. Here are some points to consider when analyzing SBC. The type of SBC that is being issued. There are two main types of SBC: stock options and restricted stock. Stock options give employees the right to purchase shares of the company's stock at a set price in the future. Restricted stock gives employees shares of the company's stock that vest over time. The vesting period is the period of time that must elapse before an employee is entitled to receive the full value of their SBC. The longer the vesting period, the less dilutive the SBC will be to existing shareholders. The fair value of SBC is the price that would be paid for the shares if they were purchased on the open market. The fair value of SBC is important because it is used to calculate the company's diluted EPS. At present, management tends more and more to use stock-based compensation. SBC can be a valuable tool for attracting and retaining top talent. By giving employees the opportunity to share in the company's success, SBC can help to create a sense of ownership and motivation among employees. SBC also can help to align employee interests with shareholder interests. When employees are compensated with shares of stock, they have a vested interest in the company's success. This can lead to increased productivity and innovation. In some cases, SBC can even be tax efficient for employees. For example, employees may be able to defer taxes on the value of their SBC until they sell the shares. Given the increasing popularity of SBC in high-tech companies, SBC has accordingly been becoming more and more important to a stock's valuation. First, significant SBC can distort a company's profits. Profits are key metrics that investors use to value stocks. SBC is reduced from profits according to GAAP. GAAP stands for Generally Accepted Accounting Principles, a set of accounting standards that public companies listed in the U.S. must follow when preparing financial statements. SBC was originally used as an incentive for management and general employees, and the management tends to report non-GAAP profits, which do not take SBC as an expense to be reduced from profits and are thus inflated manually. When investors and analysts accept the idea that non-GAAP is a better gauge of profits than GAAP net income, management then gradually shifts to SBC more and more rewards to employees. As a result, all margins are improved, taxes are saved, and even free cash flow is enhanced, pleasing investors and analysts, but at great cost. Second, SBC can dilute the ownership of existing shareholders. When SBC is issued, it creates new shares of stock. This can dilute the ownership of existing shareholders, which can reduce the value of their shares. This is also the great cost mentioned in the first reason. With those two drawbacks being said, SBC could still be important, especially to some high-growing companies that are very limited in resources of cash, because SBC is essentially delaying payments to employees to the future. Therefore, in order to give an appropriate place for SBC in evaluation of a company, the origin, pros, and cons of SBC should be carefully examined. Basically, there are two ways to handle when to evaluate a company. First, use so-called non-GAAP profits provided by management to assess the efficiency and effectiveness of the operation of a company, but stay with reported GAAP EPS for the use of valuation multiples, example, P/E ratio. Another way to think of SBC is simply treat it as an expense and accordingly calculate the margins and free cash flow. I would say the first attempt seems illogical between the assessment and the valuation, and the second method gets rid of the benefit of SBC at all and deliberately deteriorates a company's cash situation. So the next question is how to incorporate SBC analysis into my own model. My own model is called Growth Tracking Model, which is basically figuring out the most possible path for stock price to grow into the future. It emphasizes how the growth path of revenue and change of price-to-sales ratio have effect on the growth of market capitalization with healthy and adequate free cash flow. Where is SBC in this model? Well, SBC is not taken out of free cash flow because it is a non-cash item, and it is the best way to correctly understand the cash situation of a company. Where SBC does go into the model is the future deduction of the market capitalization. Let me take a real case study as an example to demonstrate how it works. Monday.com, a NASDAQ-listed company, is a platform built for a new way of working. It is a work OS that lets you shape workflows your way and boost your team's alignment, efficiency, and productivity by customizing any workflow to fit your needs. Now take a look at this chart, which is basically displaying everything we need for the growth tracking model. The pink bars represent the TTM revenue and green-blue bars represent the TTM free cash flow, which do not remove SBC yet. The chart tells a story of the company with a very high growth rate of revenue and improving and break-even free cash flow, which is a good sign for sustainable growth. Now I update the free cash flow with SBC deduction, and obviously the free cash flow has deteriorated a lot. This is because the management grants 20% of its revenue as stock-based compensation to its employees. This amount of SBC will dilute the value of current shareholders in the future, but the current operation is highly promising. How do we incorporate this analysis into the model? First, we make a sound prediction of future revenue growth and change in P/S ratio. Let's make a simple, conservative prediction, which is average 35% growth of revenue for next 5 years, positive free cash flow and unchanged P/S ratio. This prediction or assumption inflates the market capitalization by 35% annually, and if neither new stock offering or buyback happens, increases the stock price by 35% annually as well. Now SBC kicks in. We presume SBC of 20% of revenue persists, and that is 2.67% of the entire market capitalization given the P/S ratio is now at 7.5 times. That is to say, as long as the SBC margin stays constant, stock price will be cut back 2.67% every year thanks to SBC, or we can assume that conservatively MNDY stock price increases by 32.13% every year for the next 5 years. This method mimics the future impact essence of SBC and leaves the assessment of current and historical financial performance intact. This method, by the way, also explains why at present high-growing tech companies tend to massively use SBC. They are growing their revenue so drastically and then are granted so high P/S ratio, giving management freedom to use SBC because the dilution of SBC is in turn diluted by their high valuation multiples. Imagine a company with a P/S ratio of 1 uses 20% of its revenue for SBC. That translates into 20% deterioration on its stock price annually, which is insanely high compared with 2.67% of Monday.com.